Welcome to the daily update, where I'll go over the action in the market for Friday, August 23rd. Then we'll see how things look for August 26th. Now, we had quite a wild day on Friday, below average volume, but Jerome Powell gave his speech in Jackson Hole, Wyoming, and the markets really gyrated, didn't really show any conviction there for a while. We saw it go up, we saw it go down. It was a real roller coaster. Finally, we broke to the downside. We went all the way down to the daily pivot. We were able to find support there and then see some kind of a trend coming back up. But we never exceeded the high that was set on Thursday, and we never exceeded the low. So we call that an inside day. Sometimes that can be a big deal where it just means indecisiveness. So we'll have to see if the market can get some momentum going to the upside. We are potentially coming into a weak seasonal time, and we are back to being overbought in the short and intermediate term. That seemed to matter on Thursday. We'll see if it matters after Friday. I do have a thing called the SPXInvesting Program. It's still free. There are additional videos that I post there that are not publicly available. Also, you can get first access to the daily videos as soon as they're ready, as well as the weekly videos. I do delay those when posting them to YouTube or Rumble, so feel free to check that out. Just know that there's some additional things there that you may find helpful. So, okay, and then the daily video is the video that I really focus on. All the other videos supplement the daily video update. So let's go back and talk about what happened. We had a higher open. The futures were strong. It looked like, was there some front running going on here? Because the futures were building up overnight. We had, it's about anywhere from 0.5 to 0.75% rise even before the open. And so I was watching for this buy the rumor, sell the news. The market was anticipating that what Jerome Powell was going to say, the market was going to like. But then after we did open, we did see prices go up. We climbed above R1 at 56.22, but we didn't get above Thursday's high. That's one bit of concern. Prices continued to gyrate. We were all over the place, both during the speech and after the speech. We eventually dropped back down below 5,600, but we found support at the daily pivot at 55.92. Then finally, things settled down enough. We were able to trend back higher. We got back above R1, closed almost at the high. But as I said, it was an inside day. And when I go through the daily charts, I'll show you how that looks. We were up 1.15% on below average volume, another concern. We had that big down day, the beginning of August, on August 5th, and we've been chomping our way back and looking rather strong since then, enough to get to an overbought condition in the short, intermediate, and even long term. But as we've been going up, volume has been well below average, and that is a concern. We ultimately have to go with price. That's the ultimate indicator. But it's just showing that, is there really any true conviction behind what's happening here? Even on a big day when Jerome Powell speaks, we still saw below average volume. So we are positive in the short, intermediate, and long term. However, we're overbought. They pretty much came out and said, yeah, we're going to cut rates in September. And that's kind of what the market latched onto. Now, the market's already been building into that already. So it wasn't that big of a surprise to the markets. It was just more confirmed from that. And then we want to keep an eye on all the different geopolitical events in case they come through and actually have an impact on the market. So this is what Mr. Powell said. He confirmed that a rate cut is coming in September, acknowledging that the time has come for policy to adjust. But then later on, he said downside risks to employment have increased. The market could have freaked out over that statement, meaning, if employment's going down, the yield curves are going to go back to looking normal. And that just means the countdown's going to begin before we go into a recession, which may ultimately happen. But we don't necessarily have a lot of things moving that way, and the market is certainly not moving that way. Now, there's other charts that we look at that, yeah, you could suggest that we may go into a recession, but the market is not poised for that right now. So we're going to be keeping a close eye on the employment situation. And then the mass index, one of the indicators that I look at, when we were going up, it triggered 2 out of the 3 signals. Now the third signal has been generated, and this tries to suggest that we're going to have a reversal after this signal. We're not seeing that really in any of our other charts. There's always some things that we want to be concerned about. And when we're overbought, there's the potential of things moving down pretty much like we did from Wednesday to Thursday. But this is still signaling nonetheless. And so we want to pay attention to that. We have a really long list now of short-term overbought or extreme positive indicators here, including the advanced decline ratio, the short term based on 19 periods, the 20-period moving average based on the S&P, the CCI 20. Now the 14 is not there. The rate of change going back the last 10 periods, the slope oscillator, the Stochh RSI, Williams percent R, stochastics, the boom indicator. We're back kind of far away from the 20-period moving average again. And then the moving average study that we do of those stocks inside the S&P above their 20-day moving averages. It's, again, you could say this is good momentum, but it's also looking extreme. In the short term, back to kind of a long list again. The 50-period moving average based on the S&P 500, the balance of power, the TTM squeeze, the CMB composite, the McClellan oscillator for the S&P, it was extreme after Wednesday, dropped down Thursday. It's back up there again after Friday. The PMO studies, the same story there, looking extreme, then it backed off. Now it's extreme again. The Sean trend meter, the bullish percent index for the NASDAQ 100, the money flow index. And then this also could suggest good momentum. The 10-period moving average of the highs and lows for the S&P 500. That's a little bit longer term, but that's camped out looking extreme positive as well. In the long term, we have the 200-period simple moving average and the 150. So I changed this up just a little bit. The Fed, of course, has left rates unchanged as of right now, but it came out in the meeting minutes that they had possibly considered doing a rate hike back in July. They didn't do it, but they actually considered doing that. The economic concerns, at least for right now. Now we're going to be watching the employment situation. That's going to be the thing, it looks like anyway, that would come through. And if we really start to see the unemployment rate going up, the number of new jobs really going down, that's going to freak out the market because that's what we're waiting for here. The other parts of the economy seem to be hanging in there, at least for the time being. But these concerns have been subsiding. That's what happened when we had the weak employment report. The market went, oh no, we're going into a recession. This was beginning of August, and we just tanked. Then things happened in Japan. Since then, they've been shifting back more over to this positive scenario. And they pretty much have declared now that there will be a rate cut in September. The dollar was down, interest rates were down. We're at 3.81% with the 10-year yield, where after Thursday, we were at 3.86%. We're still inverted with those yield curves. I have lots of charts and breakout charts that watch each one of these yield curves, especially the 10 to the 2 and the 10 to the 3 month. They're still inverted. That's what we're going to be watching to see if they come back and turn normal and then stay normal after that. Sentiment is neutral. We are ticking up. That's positive. We had been at 48 after Thursday. We came in at 53 after Friday. So we're tipping more on the positive side since we're climbing above 50. And we are positive with the trend. The ADX is still weakening, and I should have changed the bias. This should be positive since we had an up day. But we're below the moving average. I'll show you charts of all these things here, but we're still above 20, suggesting that we are in a trending environment. And the momentum continues to be positive. All right, we just had new home sales, which came in up 10.6% on a month-over-month basis. When you take that out to an annual rate, that's 739,000 units, more than the 628 they thought. And so we look strong on a month-over-month basis. Well, we're also pretty strong on a year-over-year basis, up 5.6%. And as interest rates have been coming down, inflation seems to be more under control. We're seeing new homes actually being bought. Okay, here is the chart. And this is the seasonally adjusted annual rate. That's SAR right there. And it just shows how we're going up. And that's usually healthy signs for the economy. This is the 3-month average of the price where they're going down just a little bit. So we're below zero and declining. So they're becoming a little bit more affordable. So you have prices going down, interest rates going down, sales going up. So there is some improvement when it comes to buying homes, at least new homes. All right, then looking here, buybacks. And this tends to be when the market is really solid and strong. We see a lot of companies buying back their own stock. And this is put out by Real Investment Advice. This looks at the annual percent change. That's the black line here for the S&P. And then the stock buybacks, annual change. And you can see there's a really strong correlation. Sometimes they get out of line with each other. Back in the 90s, nobody cared back then. They were just buying all the dot-com stocks at that point. But then since 9/11, pretty much, we've seen a pretty strong correlation between buybacks and the value of the S&P 500. And this is just showing how there's a lot of money in money markets. You can still get a better return if you put your money into a money market rather than keeping it in the bank. And so that's what folks are doing. Then corporate buybacks likely to peak soon. Now, this is something to be aware of here. This is that they're running out of cash, basically, according to this chart, to go out and buy more stock. And so this has been declining as of late. It's still up, but it has been really coming down as companies are using that cash to buy their stock. And they're like, wait a minute, we need this cash for other things. We don't have as much cash as we used to have. But this chart also takes out the banks as well. So it's a little bit skewed there. And then this is credit card delinquencies. All right. This is kind of a problem. And I pointed this out in a video I posted on the website that, yeah, folks are looking, possibly retail sales are looking pretty strong. And we saw that going up, and Walmart and Target and different big retail chains, they're seeing a healthy retail consumer right now. Well, where's that money coming from? Well, they may have to go out and use their credit cards to do this, and the delinquencies are starting to come up. This is when it's delinquent for over 90 days. All right, then the value of global stocks here coming in at a whopping 125 trillion. I saw some loose number that how much money is there in the world? Well, about 400 trillion. The US has over 300 trillion of, or their global debt is 300 trillion. Well, some of the, on the positive side here, about 125 trillion of the worth out there is the value of global stocks. And then they say love diversity. I know this, all this DEI stuff that goes on these days, but what they're meaning is folks are starting to look outside of the US and looking at the possibility of, okay, maybe we want to go globally with some of our investments. All right, then looking at, and I talk about this every time I see a chart like this. When the market is in a solid uptrend and looking pretty positive, folks get into passive, either ETFs or mutual funds. These are index mutual funds like the S&P 500, the Dow, the NASDAQ 100, because there's really nothing to manage there. So they call that a passive fund. We're seeing a lot of money going into those kinds of funds because they tend, most of these high-flying managers out there that run ETFs and mutual funds, they can't beat the S&P 500 one on a year-over-year basis. However, when they have an advantage is when the market is under pressure, when we have either a cyclical bear market like 2022, the active managers did better because they can maneuver, they can shift things around. Where if you're in an index fund, if the index is going up, you're doing fine. If it's going down, because there's really nothing to manage at that point. So this is what we see folks really going to at this time. Okay, earnings sentiment. We look over here at the S&P 500. It is going up. They're feeling a little bit better about earnings going out into the future. Then we look at stocks in Japan, stocks in Europe, and emerging markets. Well, the U.S. is still looking the most optimistic here. Didn't spend any time on Twitter, and so I don't have anything to show you there. I'll look at it over the weekend. We'll see if anything interesting pops up. But this is, and I've chopped this back down to 5 days now. We're kind of more well removed from the decline and the move up that we've seen since then. But this is Thursday where we gapped higher and then boom, ended pretty much at the low. Well, then we gapped higher again on Friday. We got up above R1, but we never made it above the high that we set on Thursday. And we just could not get above that. And we're just gyrating all over the place. It's like a roller coaster. Or maybe you get seasick watching this, and then we finally broke a little bit lower. It looked like, okay, maybe we're going to start heading down. Well, we found some support here at the daily pivot. Now, this is when things calmed down and seemed to be trending a little bit better. We were able to work our way back up above R1, closed not at the high, but near the high for the session. So this was the more positive part of the day that showed a little bit more conviction. Okay, the intraday um, just shows how the futures were really climbing here even before the market opened, and then we saw the gap higher even from that, and then here's all the gyration and everything that happened throughout the day. This is still a bit of a concern to us on an intraday basis. We still see value, the red line, outperforming growth, the blue line, even though they are on different scales. This had been showing a real improvement from August 5th, going up until recent highs that were set. Well, we've been coming back down, and we didn't see growth have a really spectacular day on Friday, and it was virtually unchanged when we look at this intraday ratio. But growth was up more than value, but not by all that much. And growth was up less for the mid caps and up less for the small caps. And so we actually went down with the small cap growth to value ratio. We declined with the mid cap growth to value ratio and the S&P growth to value ratio. This is favoring more small caps, mid caps, more value stocks. At least right now, those seem to be more in favor. What we want to see is growth outperforming value, and we certainly didn't see that in Friday's session. And discretionary did bounce up a little bit here, not really taking much of a leadership role by any means, but it has been showing some improvement as of late. And we actually came down here. When we look at the growth of value ETFs, we're coming down and we're more inside the rainbow currently. So not a good day of growth versus value, even though we ended up higher. Large cap growth, it was up itself, and we're still above the 50-day moving average. And watching the trend, this is what I'm talking about here. We're below the moving average and we continue to decline. The green line's actually coming down. Okay, we had an up day. Now, if you look up here at the top, and I'll try to point this out on some other charts too. This is Friday's bar right here. You notice how we did not get above Thursday's bar, nor did we go below it. That's called an inside day. And some technical analysts are going to say, ooh, sometimes this could be a bad thing. This might signal a reversal because we couldn't exceed the high, nor did we exceed the low. This shows indecisiveness, which often happens at a top. Now, we don't know. It's just something we want to be aware of for right now. But we're still positive because the green line's above the red line here, but the green line's going down, but the red line's also going down. So there's not a real conviction behind the trend currently. In the short term, also the green line coming down, we're still trending. Now we're getting to a point here in the short term. If we drop below 20, that means we'll be in a non-trending environment. So we want to see if something like that's going to end up developing. Volume continues to be below average. All right, sentiment. We're really coming down with the Ulcer Index. It finally waked up and said, oh, things are going up. Maybe I won't be as fearful after all here. And we did decline with the VIX on a closing basis, as well as the bar chart. And the VIX of the VIX also came down. It was going all over the place itself until we finally settled down at the daily pivot and were able to move higher. That's when things on a sentiment basis started to show some improvement. This is a concern to us right now, the SKU index. It's suggesting that there's a big move that is being expected by the market. Now, as I always explain, the VIX uses at the money options to be calculated. The SKU index uses out of the money options to be calculated. And when we get up into this red area, the market is expecting something. We don't know if that's an upward move, a downward move, a top, a bottom. We have to use other charts to give us some context for that. But the momentum of the VIX continues to drop off after it really spiked back in early August. But if we stick to seasonal norms, if we're coming down with the VIX, if we start going back up with the VIX, which can often happen in late August into September, even into October, that would put some real pressure on stocks because as the VIX goes up, stocks are going down. And we did decline with the equity put call ratio on the daily chart. We're going back up with the 5-day chart, but we continue to decline with the 10-day chart. So a little bit of a mixed picture there. This fear gauge that we look at did decline, and the other fear gauge that we look at did decline as well. So sentiment has been settling down and still remaining more positive for the time being. We're keeping an eye on this, the spread between risky and not as risky bonds. This is the chart that we're looking at. We're still getting a higher reading than we had been before, but it has, as this goes up, that means fear is decreasing. And if we're more positive on the market, that's what we want to see. All right, then we look at the risk on to risk off ratio. It was up as folks were willing to jump more into stocks in Friday's session. But the small caps outperformed the large caps. Small caps had a pretty good day, but they haven't really broken out yet. And I'll show you that when I get to those charts. So we're seeing this ratio coming down a little bit. Typically, in more positive environments, we want to see this ratio going up. And the volatility risk premium, after getting very low, is starting to turn back up, but still is well below this band here. All right, advanced decline line studies looking good here. You can see, actually, I have these charts in wrong order. These are the new highs and new lows, where we just saw a real breakout of the new highs. That's causing our 5-day and our 10-day to go higher. Now we look at the advanced decline line, breaking out to a new high here based on price, not breaking out yet based on volume. So that's a bit of a negative divergence, but taken together, both of these are above their moving averages and showing strength. So that's positive with a warning sign. And on a 1-day basis, the advanced decline percent, maybe we overdid it. This is just 1 day to the next. And the accumulation distribution, after dropping back down with the boom indicator, starting to go back up, but we are above an advancing moving average. This is still positive, but we're a little bit concerned about the distance away from the moving average. In the short term, the advanced decline ratio is now looking extreme, where we're looking positive still with the more intermediate term ratio. And here's a further breakout of the 19-day advanced decline ratio, getting extreme based on price, just barely getting extreme based on volume. Shaken money flow, another smart money indicator, continues to look positive. This is a concern too, because this turned and started to go up when we were still going down with the S&P. Now it's turning and starting to go down as we're going up with the S&P. We want to be aware of this. This is also another smart money indicator. Is this telling us that there could be some weakness ahead? We don't know, and this is only one chart, but we want to be aware of these things. But the vortex is looking really solid. The green line's going up and the red line's going down, almost to the point where the red line's looking extreme negative. And the boom indicator, getting kind of far away from the 20-period moving average, also getting just, not quite, but just a little close to being extreme away from the 50-period moving average. And when we look at the cumulative S&P 500 advanced decline line based on price, breaking out to new highs, looking good, but not breaking out based on volume. Here's that 10-day average of the highs and lows for the S&P. Getting up, and usually we take this as showing good momentum over a 10-day period of time. So this is positive, but it is extreme, but it can stay here for a long time in really positive environments. And we're looking good here when we look at the S&P compared to the NYSE advanced decline line. Looking pretty solid for the time being. Then we look at a cumulative advanced decline line for the NYSE based on price, just barely breaking out here, but looking pretty solid with this NYSE advanced decline line and this other NYSE advanced decline line. The broader market's holding up quite well right now. And we break it out based on common stock, based on price, going to a new high, also hitting a new high based on volume. We're not seeing that confirmation with volume for the S&P. But when we look at all of our advanced decline lines, everything is looking pretty solid after Friday's move. Short term, we have not set a new all-time high. It was an inside day, but we're still above the 50-day moving average. The trend is still up. The 50 is above the 200, but look at how volume continues to be well below average. We're getting extreme when we measure just the S&P 500 with the 20-period exponential moving average. The 50 is starting to get extreme, looking positive, but not quite extreme with the 200. And then our short-term indicators, the Stochk RSI is extreme positive, as is the Williams percent R. The CCI 14 is not, and actually declined a little bit, but the CCI 20, it declined, but it's still extreme positive. And with our stochastics, looking extreme in the short term, intermediate short term, and now the long short term. And the reason I say it that way is I like to say this is a further subdivision of the short term time frame. All right, the condition of the 20-period moving averages here. Looking pretty solid above both lines, and the green line is above the blue line. So on a trend basis, we're looking pretty solid right now. Also with our regular simple and exponential moving averages based on 20 periods, looking pretty solid. The force index is positive and above zero. That's why it's positive. And going with the rate of change going back 10 periods, we're starting to get extreme again. Now, it doesn't mean we're going to stop. Sometimes it means we may be due for some sideways action for a while because the market's moved up pretty quick. But we're not extreme here with our standard deviations chart. We're at the high end of the +2 channel. When we get concerned is when we get up into the +3 channel. And the balance of power is back to being extreme positive again. The CMB composite, it's coming down, but it's still extreme since it's above the black line. Here's the condition of the 50-period moving average, looking pretty good. It would be even more positive if the red line could come back and cross above the blue line. Has not done that yet, but they're both still going up. That's positive in and of itself. And here's the simple and exponential moving averages. We have not broken out. We have not set a new high here, but we're above both of these moving averages. Here's our moving average tree. The longer we stay up here, the more these shorter term moving averages are looking pretty good and starting to cross back above the 50s. And turning more positive here with the go, no go, with the darker blue bars. And hitting the highest high value now above the midpoint's going up. That's still positive. TTM squeeze above this black line, looking extreme positive, but momentum for the time being is still positive. Here's a longer term chart to give you some perspective of what happens when we get above this black line. Standard deviation coming down as we've been chopping around the last few days because this calculates the last 10 periods, but it's still pretty high. Excuse me, and the ease of movement just skyrocketing up here. The path of least resistance currently is still up. The Erin indicator is above zero with the oscillator itself. That remains positive. And we're getting extreme, but we're still positive here with the S&P McClellan oscillator. We're above zero, but starting to look a little toppy here, potentially. But this could still go higher. When the McClellan oscillator is positive, that means the summation index based on price is going up. We're also seeing it based on volume going up, and they're confirming each other. So this is more late short term into intermediate term, and even somewhat long term, depending on how you want to use this indicator. We're looking pretty positive right now, even though we notice these negative divergences in times past. And we're looking positive here with the NYSE McClellan oscillator above zero and going up. When it's positive, that means the summation index based on price is going up and volume. And this is a little bit of a concern. We had, pretty solid up day. Swenlin trading oscillator based on price just barely ticked up. We actually declined based on volume. Now we're still positive since we're above zero, but sometimes this gives us an early warning. But when we look at momentum, the PMO positive by itself, positive based on price and volume. We're getting a little toppy with the PMOs that are rising, but that could suggest good momentum. The buy signals are going up, but getting close to being extreme, and the PMOs above zero continue to go up. But we're still neutral with the Elder's impulse system for the S&P. We're positive with the parabolic SAR since the dots are underneath. The slope oscillator is still positive, but getting above this green line could be getting a little toppy here, but it can go higher and has gone higher in the past than where we're at now. The MACD, a little bit more short to intermediate term, also still looking positive on a momentum basis. So all of our oscillators, short, intermediate, and long-term, continue to be positive. The copy curve, another momentum oscillator, positive. Sean trend meter still up in this initial extreme positive territory, but remains positive. And the bullish percent index, not really breaking out, not extreme, but still looking positive, suggesting there's a lot of buy signals generated by the point and figure charts inside of the S&P. We're going up with the NYSE bullish percent index. That's positive. We actually came down a little bit, but we're extreme positive with the NASDAQ 100 bullish percent index. The money flow is positive, but looking extreme positive. Going back up with the ultimate oscillator, but still above 50, that is positive. We're above an advancing moving average with on-balance volume, and we're above 50 with the RSI 14 and 9. Those are positive. Getting a little extreme here with those stocks above their 20-period moving averages inside the S&P. Now, it could still go higher than where we're at, but it is going to top out, especially if it gets up to that 90%. Sometimes that means a wash to the upside if we end up hitting that level. And we're looking pretty solid here, but we're right at 89.4. If we get to 90 or above, sometimes that just will suggest exhaustion. Folks are going to want to come in and start taking profits on a short-term basis. But when we look at the stocks above their 50-day moving average, we're looking positive there. We went up with the 100s and the 200s. So longer term, we're looking positive with that. This is the mass index. The first trigger was when we went above the red dash line. Trigger number 2 is the blue line. Trigger number 3 is when we, actually there should be 4. Trigger number 3 would be when we come back down below the blue line. But the actual, here I am triggering now, is when we drop back down below the red dash line. And this is suggesting, since we were going up to make this signal happen, that a reversal may happen. But again, look at other times when these signals were generated. Sometimes they were good, sometimes they were not good signals. All right, the Pring bottom fisher generating a buy signal even well after we had that low in early August. So it looks like we could be starting a new 50-day cycle. We won't know that until we actually look back using hindsight to know, oh yeah, I guess August 19th actually meant something after all. But that's not the way I like to do things. I like to be looking using foresight, not always hindsight. Ichimoku cloud still above the cloud, the blue line's above the red line. So this support level, we came down, actually dropped below it. Now we're breaking back above it. So that's looking more positive there. A weekly chart of the S&P, we closed pretty much at the high above R2. So that's looking good longer term. And we're coming right up to the 61.8% fib extension level. Now, we were able to get a little bit above that when we set the all-time high. Is this providing some kind of overhead resistance? Potentially, unless we can break through that. Now, if we start coming down, we'll go, oh yeah, this was providing overhead resistance. All right, but on a trending basis, we're still looking solid with the hike in ASHI being positive. The Kegi chart is black and pointing up. That's positive. The Renko is positive, and the 3-line break is positive. And then long term, getting a little extreme with the 150, and we're above this red line with the 200-period moving average study. Positive across the board with the Keller market model. All time frames, all indexes that we plot here. Still negative with commodities across all time frames, as well as the US dollar. Still positive with the decision point scorecard across all time frames and the trend model and PMO signals. All the sectors ended up being up with discretionary. We want to see more of this. This is kind of a pseudo growth area that we would like to see doing better. That's been a real disappointment in 2024. It was up the strongest, followed by real estate. They like lowering of interest rates. Tech had a good day as well. The area that did it was still up, it did the worst positive, were staples and utilities and healthcare. These are 3 defensive areas. Utilities, we're just keeping an eye on these things, but they were up. It might have been more of a sympathy rise at that point. Everything was blue or green here with the alerts that were triggered or signaled during the day. The one that could be a little bit is that the euro set a 52-week high against the dollar. But Canada, Canada, have a good weekend there. But all of these things are positive across the board. And the equal weight is doing well when compared to the S&P 500 weighted index. And this actually came down just a little bit as the large cap saw a little bit better performance. Actually, no, when this goes down, that means the rest of the S&P 500 slightly outperformed the weighted S&P 500. We're positive here with the new highs, new lows, raw score for the NYSE. We were up with the Dow, but not setting an all-time high. We've switched back to positive with the diamonds for the Elders Impulse system. And this was what I was picking out on Thursday on the NASDAQ. It came down to the 50-day moving average. We bounced up off of that and we're above this pivot point. So that's turning more positive. We did the same thing here with the NASDAQ 100. Came down to the 50-day moving average. We were able to get back above that and above the pivot point. But we still remain neutral for the Qs when looking at the Elder's Impulse system. But the momentum for the NASDAQ 100 is positive. We're above the moving averages here with the QQQs, and that's showing an improvement there. We still have not been able to get above this 38.2 fib extension level here for the Qs. And they also had an inside day. We're not able to exceed Thursday's high or Thursday's low. Small caps up 3%. Is it finally going to happen now? We scream to the upside and then see many days of give back after that. Is that what's going to happen now? We don't know, but there's a lot of folks that just had a wild ride in 2024 with these small caps, but they are positive with the Elder's Impulse system. And when we look at the Russell 2000 small caps, above the 50 level with the RSI, above the 50-day moving average, the momentum is positive now. We look at the small caps to tech ratio, ticking back up here, meaning that the small caps had a better day than the tech sector. The mid caps also were able to get above this pivot point, and they were up over 2%, but not breaking out, at least as of yet. And they've gone from neutral to positive with the Elder's Impulse system for the mid caps. Wilshire, a broad market measure, also up 1.32%, but not setting an all-time high. Here's the total U.S. stock ETF, also up 1.27% above its 50-day moving average, but not setting a new all-time high. The Staples to tech ratio actually declined a little bit here as Staples underperformed tech, but tech didn't have all that great of a day in and of itself, but not a terrible day either. The financial sector looking solid, up 8.86% here. That's a good sign for the economy. And the home builders ETF that we've been watching, it looks like they're coming more back in line with each other. So the S&P's been going up. The home builders now finally kicked into gear. They went up, had a really solid day. So the correlation is starting to get back to where the S&P, where the S&P and the home builders ETF move more in lockstep with each other. So if this continues to give us more of a high reading like we usually have, I'll drop showing this in the daily video. The FANG index came right smack up to its 50-day moving average. Does that mean something? We'll have to see. We came down to the 200-day moving average. We were able to get above the 50, drop below it, and we closed right on it on Friday. Here's another look at a longer-term chart of the FANG index where we dropped below this trend line. We were only able to get back above it. Thursday, we closed right down at the trend line. We've been bouncing back up from that. That could be positive if its support level holds. Apple was up over 1%, looking pretty good now. Amazon was up over 0.5%. And we had Microsoft up 0.3%. Google was up over 1%. Meta was actually, looks like it was down 0.75%. And NVIDIA was up 4.55%. They're going to be coming out with earnings here pretty soon. And that's party time for the markets. So we'll see how that plays out. Tesla was up over 4.5% and still above its 50-day moving average. Netflix was down 0.33%, but still above its 50-day moving average. Then we look at a broad market measure of the 5-period moving average of the highs minus the lows. We continue to be positive here. This is suggesting the broader market is hanging in there for right now. We look at U.S. stocks versus world stocks, pretty strong in the short and long-term correlation. Oil was up, but still just into the mid-70s now. We're watching this if geopolitical things really start to escalate in the Middle East. And we're coming down with the dollar. We're just about ready to see a death cross here on the daily chart. We already saw a death cross on the weekly chart. And here we're breaking back below this trend line here for the dollar index. We were down with the 10-year yield. We were up with the 10-year based on price. I'm going to go through the stock to bond correlations over the weekend in those videos, but I wanted to show this. Home construction really liked what it heard on Friday. We're breaking up, not quite setting a new all-time high with this ratio, but well above the rainbow when compared to 3 to 7 year bonds. And then not really seeing all that much here with the growth to value ratios coming back down, dropping below the moving average with the Qs to S&P. Discretionary to S&P. Discretionary had a pretty good day, so it's slightly above the moving average, but we're coming back down to the moving average when we look at large cap growth versus large cap value. And the large caps coming back down to the moving average, at the moving average with the mid caps, dropping below the moving average with the small caps. This is not what you want to see if the market's getting ready to take off, but this can rectify itself. Okay, the S&P to utilities ratio went up a little bit here, but not really showing any conviction right now. And we're going back down just a little bit here with the Staples to S&P ratio, but we want to see this really decline to give more support to the S&P. So what's our outlook? The technicals are positive. We are seeing some vulnerabilities as we look through the charts here, but we have to follow what price is actually doing. We are now back to being overbought again in the short and intermediate term, and we are below average with volume. We're going to get durable goods on Monday, and then all the crazy stuff that could escalate at any given time with what's going on in the world. Here is the calendar for the upcoming week. We're going to get we're going to get the second reading of GDP on Thursday, but we've already seen the first number. So if it comes in about where we saw the first number, it may not have that much of an impact. The big report is going to be Friday. PCE and core PCE, personal income and spending and consumer sentiment. So a lot of these, yeah, they're important, but the big one is going to be in Friday's session. And then here's just a look at the upcoming week for this economic calendar. Seasonality, we're neutral to positive with the Dow for August 26th, where we're positive with the S&P and NASDAQ. Monday is the most positive day of the week. We'll see, folks, over the weekend, if they come in off the beach or out from the picnic table or something and say, oh, look at how the market went up. I'm going to jump on my computer and do some buying. We'll see if that carries into Monday's session. Then this is kind of interesting because this chart looks at 2023 to see how it performed then. This is what have we been doing in 2024 until now, where Monday is not quite as positive in 2024. Thursday tends to be the most positive day, even though it was a down day this past week. But this kind of gives you a little more up to date now that we've gone through enough of the year to show this. And we do see a little bit of positive seasonality here. Now, this chart, this is actually put out by Don Bird. He was a little off. If he's planning on going to Chicago to watch the Democratic convention, he's going to get there a little bit late. Maybe he can go watch some White Sox games. You know, they're doing just about as good as the Mariners these days. But we do see some positive seasonality for Monday's session, a little bit of choppiness, and then quite often some trailing off as we go into the latter part of August. And trying to compare all election years with what's been happening with the S&P, and then an open field, which is really what we're dealing with right now, even though both sides have declared and nominated their candidates now, but it's not the current president. So that's kind of where we're following with this. And sometimes we see some weakness, not so much in August, but we might see some of that coming into September. September is pretty negative looking out, where August tends to be positive. We also see September being negative on this chart. Just something we want to be aware of. Who knows? The market could buck the trend and actually look pretty good. And then when we take August through October on a seasonal basis together, it tends up being down over that 3-month period. But August tends to do pretty well during an election year, where September does not do very well. And then trying to compare 2023 with 2024, kind of working our way a little bit more through August now, where you can see back in 2023, September was actually not so bad. It was getting into October. That's when we really started to go down. And we actually set the low in late October, and then we're able to bounce up off of that. Okay, the warning signs. We're keeping an eye on these defensive sectors. We want the growth areas to do better, more than just one day here, one day there. So we're concerned that staples and utilities, as well as healthcare, which are more defensive, are performing as well as they are. We're keeping an eye on energy, mainly for geopolitical reasons. The 5-day equity put call ratio is going up. That's negative. And growth to value, discretionary to staples. Yeah, they're improving, not so much on Friday, but they're certainly not leading even when they do go up. And the home builder study, it was diverging. Now it's coming back more in line. I'm probably going to take that off if we continue to see that. Quite a long list of positive things here, but still some things to be aware of. We're still going down with the 10-day equity put call chart. Accumulation distribution could be getting extreme there with the boom indicator. Chaikin money flows looking pretty positive, but we're starting to see the Chaikin oscillator. It's positive, but it's been coming down the last few days, and that is a little bit of a concern. The advanced decline lines, the S&P NYSE McClellan oscillators were extreme with the S&P McClellan oscillator, but they're all still positive there. And the Swenlin trading oscillator, yeah, it's positive, but it was down based on volume and just kind of blipped a little bit based on price to the upside. The parabolic SAR, though, is positive. Our oscillators are positive. The bullish percent indexes were still extreme with the NASDAQ 100 bullish percent index. Ease of movement showing a lot of strength right now. The money flow, which is looking extreme. Ultimate oscillator, copy curve, vortex. And with the vortex, notice how the red line's almost extreme negative there. The financial sector is looking really solid, though, for the time being, and the momentum for the NASDAQ 100 is positive. So, our conclusion, we're positive, we're back to being overbought, and we're below average with volume. We're overbought in the short and intermediate term. We're also positive, but a little bit overbought, you could say, on the long-term basis as well. So thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.